Friday's sell-off was one heck of a way to finish up the year. The S&P still returned over 24% in 2023, more than double the quote average annual gain. But will Friday be an early indication of what's to come in the new year? I mean, is the market already priced in perfectly the promise of AI and substantial rate cuts from J. Powell, or is there more room to run in the upward direction? We'll explore that idea and more in today's episode of the Weekly Watchlist. As always, check out the links listed down below in the description. Hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. We begin this week's analysis on the SPX yearly time frame chart with the max available price data, and we are looking at a logarithmic price scale. We don't often use charts like this, but this provides great context around the question we asked in the introduction there. Is it possible that the market rally could continue? If you ask news and media outlets, they say no, the recession from 23 that never came is going to come home to roost in 2024. Or maybe equity valuations are stretched far too thin. The market can't even inch in the upward direction. But if you look at historical examples, the charts would argue on the contrary. The first metric that we're going to use is time. The time of this rally right here is 18 years. The time of this rally right here is 20 years. If we project out 20 years from 2013 when we broke, and by the way, the method we're using is once we've broken the preceding all-time high, we're measuring additional gain. Break the previous all-time high, additional gain, break the previous all-time high, additional gain, right? So if you add on the 20 years, that brings you to 2033, or 18 would be 2031. So time-wise, yes, good to go, checks out. But time's somewhat of an arbitrary measuring stick, right? Let's instead talk about magnitude of return. This one from the 50s into the 70s is 283% in the upward direction. This one with the dot-com boom, if you will, in there is 1,144% in the upward direction. The current rally that we're sitting on is in blue, 205% since the break in 2013. So if we're tracking much more closely to the purple box from back here, yeah, we still have some room to run in the upward direction. The purple box would project that roughly measured move high around 6,000 in the SPX. Let's call it 6,000. All right, if we go for a full 1,144% return, we're talking about, get ready for this, hold on to your seat, 18,000, let's call it 250. In the SPX. Very, very impressive return profile. So magnitude-wise, can we continue in the upward direction? Yes. It doesn't mean we have to get to these areas, but the market has proven in the past that these types of returns can take place. Now, let's address something real quick. This is a sample size of 2. So statistically relevant, maybe not so much, but it's all of the price history we have for the S&P 500. So unless you want to make something up, I think we should stick to what's on the screen in front of us. Now let's get a little bit more interesting here by taking a look at the yellow lines. This is the measured move in terms of percentage from just the dot-com boom, if you will. 235% move from here up to the high that was set in 2000. If you think of that as being somewhat equivalent to the possibility of an AI boom walking forward from here, remember that we have the promise of AI, now we just need to see that promise fulfilled and productivity move through the roof for GDP to sort of see a benefit from that, right? If you believe that that is going to happen, a similar style return, and we were conservative here, this is 235%, we stacked on 200%, all right? That would bring you to an SPX somewhere around 14,250. Now again, the point of this analysis is not to say that we go here, not to say that we go here, or not to say that we go here, or not to say that the rally must last until 2033. The idea of this analysis is to say it is unfair to simply look at the market and say, no, it's gone too far, too fast, the market's been rallying nonstop, we can't possibly continue in the upward direction. History would say otherwise. Doesn't mean we have to get there, but it's happened in the past, it can happen again. The last caveat here is that this has no bearing on how we should act when Tuesday opens up, right? The first day of 2024, you should not be long calls looking for 18,000 plus in the SPX. We're talking about a long time duration here, but for now, the idea is, can the market rally continue based on history? Yes. We're back home on the SPY and we're looking at the monthly time frame chart now that December has officially closed out. Solid green bodied bar, higher low, higher high. It speaks for itself. Buyers are in control on the monthly time frame. In terms of monthly trend, it's certainly up. We have lows, higher lows, higher lows. Remember that this was structurally substantial, or significant, I should say, off of the inverted head and shoulders neckline retest at the lows of October. And of course, we've just broken out for a big time higher high, very close to the all-time high as well. While we're talking about it, may as well, if this is going to turn into a double top, just remember that you need to take out the neckline and you need to bring in some sort of big time lower low. Obviously, you would flip into a weekly downtrend far in advance. This does not strike me as a top of mind issue. Instead, what you should be thinking about on the monthly is if there is a reversal into the early stages of 24, can we hold up over this breakout point? Can we stay above the top of the cup and handle? So a couple of measured moves. The first one is coming from the base of the cup to the top and then pulling back to the low of the handle. That measured move would bring us somewhere along the lines of 520 in the S&P 500. If we take the next one, which would just be stacking the 100% extension from the top of the cup, that gets you much closer to 570, we'll call it for round numbers sake. And then the last measured move, which we haven't talked about in quite some time, is coming from the low here to the top. This is technically a monthly bull flag, not for nothing. And by the way, while we're still zoomed out, holds the 50 SMA, holds the 50 SMA. All of this is happening over an upward sloping 50 SMA on the monthly. So bullish or bearish? You tell me. Certainly more bullish than bearish. That big time measured move from the flag is closer to 610.29. Now let's bring it full circle. What did we just uncover about the roughly mid 50s to 70s rally in the 50s to 70s is that it was a 283% gain. If we projected that on top of what we've gotten since 2013, the target was roughly SPX 6K, and not for nothing, just divide that by 10, of course, that gives you your SPY number. That's 600, certainly within striking distance from all of these measured moves. And what about the weekly time frame chart? What do we see here from a candle structure and location point of view? It's worth talking about because we do have, again, another change in character out of the weekly. Remember that all of these bars, solid green body bars straight in the upward direction. Now we're getting a little bit of an inverted hammer. It's still got a green body on it, so we know that the buyers did a great job of closing over the opening print, but sellers are starting to step up near the highs of that weekly range. The other big difference here is the previous weekly bar closed right at the highs of the week preceding that. And this time we've closed more firmly inside of, it's very close, but a little bit more firmly inside of the previous weekly range. And again, I want to reiterate that we have a green-bodied bar, so we stayed over the opening print. The bears are not really building an overwhelming edge, but a change in character nonetheless. Now, what do we know about the weekly time frame chart? It's been this way for about 9 weeks now. This is the 9th green week in a row up here. We have not seen a higher low pullback, right? Lows straight up to the highest highs, far exceeding this previous top. Of course, the all-time high is a contender around 479.98. We're right there. We are right there. So if the market does pull back, there's ample room to find a higher low. The ideal level has not changed. It is still 459. We are not yet getting confluence with our Fibonacci's coming from the low up to the high. You can see that your 38.2 is still more closely aligned with this previous pivot top over here. 451.10 is the daily breakout area that we care about, so let's not split hairs. That general zone, let's call it 451 for round numbers sake, is still important, and we can come in with our anchored view apps as well. You're starting to get confluence with the October low anchored view app there. All the other ones not really in force. And the last thing I'll say about this 451.10 is, although yes, we are getting some change in character up here on the weekly, I mean, is this in the cards for the coming week's worth of trade? I would certainly think not. It's a shortened holiday week again. It is the first week of the trading year. It is possible, based on some daily indications, hourly indications we'll look at in a minute, that we could see a pullback begin, but we're not talking about 451.10 into the coming week's worth of trade. Let's lastly check in with our weekly volume profile just to understand if there are any, developments happening over here. It really just reinforces the idea of 459 on the weekly time frame chart. Any higher lows there make a whole lot of sense structurally here over the 38.2 volume shelf as well. The last thing I'll say is that this 471 area has actually built out as a bit of a high volume node, and we're actually holding over it. So again, it's hard to say that the bears have built an overwhelming edge here on the higher time frame charts. It certainly would not look like that at all. Sure, mild pullback, but Armageddon style breakdown? Absolutely not. On the daily time frame chart, let's first evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number is 480.64. That is a new all-time high, and obviously that's a higher high in the trend sequence. That, of course, is bullish. If we're contained by the lower bound, the number is 469.97, and technically speaking, that would offer a higher low, but as we talked about on Wednesday, we get into some trouble if we start trading underneath 473.75, the ideal daily higher low, if it requires a breakdown of 473.75, which again would be trouble in the first place, is still here though at 471.50. So we know our ups from downs. We know that we're in a daily uptrend. Of course, this could act as a higher low. We've pulled back from a higher high. And of course, we flipped into an hourly downtrend intraday on that Friday session. As we'll note from the Santa Claus rally, technically it runs until January 3rd, and the measured move is actually right on par with the upper edge of this week's expected move, closer to 480.50, 480.25. New all-time high basically is the suggestion there. So on the daily chart, things are looking good. We did technically print out a hammer on that Friday session. Buyers did step up and defend the structural area, and I would continue to hold that as your key line in the sand. 473.75, if you're only going to have one level on the daily time frame chart, should be that number. If we're over, you've got to remain bullish. If we're under, I would start to target the bottom end of this range here. This turns into a look above and fail, and then through that, things start to get a little bit more dangerous for your weekly pullback, starting to look for 459 as a possible downside target. Again, as of right now, to finalize the daily chart, this strikes me as a little bit more bullish than bearish, noting the buy side reaction for a possible daily higher low at 473.75. And the hourly chart for our last time frame really reveals the weakness from the buyers. As we talked about on Wednesday, you get liquidation break number 1, number 2, number 3, number 4 into the end of day, midday there on the Wednesday session last week. Early on, maybe I would really just consider that Thursday session balance up here. But the beginnings of a liquidation break on Friday, right? That's our sell-off. Now, I say beginnings very intentionally because for a liquidation break to truly just be a liquidation break, you need to actually recapture the origin of where it began from. And obviously, you can see that happened here with the excess. You can see that happened here with the excess. You can see it happened here with the excess. Even intraday, right? We certainly made a new higher high into the close on that Wednesday session. And the reason that you want the recapture of the origin of where the selling began from is because any short-term momentum style sellers who chase that move lower will likely stop out if you exceed the place where the breakdown began. So as long as we're underneath, the threat on the hourly time frame chart is actually quite clear. This remains as overhead supply, and we start counting trend lower. Highs, possible lower highs as long as we reject and stay underneath 476.25. Any sort of H pattern in here back to the equal low starts to even suggest a lower high double top. You could think of it with some context over here as a head and shoulders. Doesn't matter what you want to call it, but we know that sellers feel emboldened underneath the low here where the liquidation break accelerated, where we got it on the Friday session. 473.75, equal low breakdown there is dangerous. Sure, you could get the daily attempt for a higher low here, but then we know at that point we're in a firm hourly downtrend. Really, the target is the bottom end of the daily balance range for the full look above and fail at 468.50. So that's how I envision the downside playing out for a pullback this upcoming week if we cannot recapture 476.25. Obviously, the flip side of this coin is that no, this does end up holding as a firm daily higher low. We can count trend on the daily, right? This would be low, sort of higher low, even like hourly higher low, and then some sort of break higher low that keeps this from turning into overhead supply as constructive. We'll start looking for those upper targets. All-time high, Santa Claus rally measured move, upper edge of this week's expected move, and one we didn't discuss on the daily, of course, is just the doubling of your daily balance range, which is much closer to 481 as a possible target. So that's really what I envision being important early on into 2024. 476.25 and 473.75. If we bring out the anchored view apps from an intraday perspective, what you'll notice is that we did get great confluence on Friday with the anchored view app from the top of where this breakdown came from. So, and over time, not for nothing, but this is the FOMC anchored view app, right? As that starts to march forward, it's probably not going to happen early on in the week, but later on in the week or into the future, if we need reinforcements, it'll probably be there to meet us once again at 473.75. So for the most part, we know the game plan, we know our pathing. Consolidation in here is less than ideal because it offers a lower high. Equal low breakdowns get dangerous all the way back down to 468.50. If we can pop it for a higher low, good to go. Looking at 481, let's call it, as a round number target overhead. Market internals are always supporting evidence exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right hand corner. For the most part, let's examine the breakdown from the Friday session. This is not just a liquidation break in my eyes, because we did have bearish internals as that breakdown was taking place. Same thing over here in the advanced decline line, and same thing over here in the cumulative build out of the tick. If you recall back to all of the previous liquidation breaks, you could remember that the internals were actually bullish as those breakdowns were taking place, and that was not the case on Friday of last week. So in my eyes, we have to treat this with a little bit more severity from what we even saw of last Wednesday, right? Last Wednesday, the internals even there were not like horrendously bearish. They really weren't that bad. But this time around, yes, the bears did have some edge through the duration of the entire trading day. Market profile is always exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. The big issue out of this particular chart is what's happening with the value area, specifically on the Friday session. It not only moved lower, but you'll notice that we have a double distribution on Friday separated by C print single prints. Right, so technically speaking, this could be thought of as day number 1, and this could be thought of as day number 2 underneath the base of those single prints. And now in the lower day, yes, the value area was slightly higher. The point of control was slightly higher in that session. There is decent excess at the lows. There's decent excess at the highs. But if the buyers were truly, again, going to have just a liquidation break on their hands, if it was just short-term momentum sellers and nothing more severe, then you would have imagined a retracement into the close. You'll notice that M period top ticks right around in here, right? That is underneath the upper distribution. If I split this profile, what you'll notice is M and L period top out underneath your A period low. So the buyers were unable to retrace what should have been thin structure over here. They didn't have to do battle up through the C and D overlap. It was just single prints. But they were unable to do so into the close, and obviously that does strike me as slightly more bearish than bullish. Now, we haven't formally flipped into that hourly downtrend, but the ingredients are there with the rejection of this as overhead supply. Shifting gears to the QQQ monthly time frame chart, clearly, we remain in a monthly uptrend. The December bar is solid green, higher low, higher high, lows, higher lows, higher lows, higher high along the way. Of course, that's a new all-time high. So let's take some measured moves from the cup and handle. Same thing we were doing over in the S&P 500 to the base of the pullback, as well as to the top, and just stacking directly. I would not really consider this as much of a bull flag. The retracement was much deeper, as we know. So we're not going to use that as a measured move here on the Q's monthly time frame. These expected moves, measured moves, I should say, are closer to 475, we'll call it, and 520 out of the QQQ NASDAQ 100. Of course, as we were talking about on the S&P as well, or I should say similarly, if we do get a monthly pullback, respecting the previous breakout top from the handle of the cup and handle is the primary watch here. That number, just to give you an FYI, is closer to 387. Let's drop it on down to a weekly time frame chart. Let's get rid of all of these fibs, and we will start from scratch with a new fib, actually, after we discuss candle structure and location. So structure, very similar to our S&P, inverted hammer with a larger upper wick, smaller body, and a little bit of a lower wick on bottom, indicating some sellers stepping up near those highs. Regardless, we did, technically speaking, close green, so you do have a higher low and a higher high. We closed more firmly inside of the previous week's range, which is a character change out of the Qs. Haven't done that since the bigger weekly and even daily balance area from back down over here. Let's come in with those fibs, though, from the lows up to the highs. Just remember that your 38.2 is the bottom of this consolidation. Ideally, on the daily chart, you do not enter that consolidation in the first place. You get a higher low that stays above that, and that number would be more closely aligned with 393. If you do extend the 38.2 to the left, it does make sense based on the summertime pivot high, but again, ideally on the NASDAQ, it's 393 here. Let's take a look through the lens of weekly anchored VWAPs. Let's do that for the Qs, and you'll notice that you're not really getting confluence here yet. It will take a couple more weeks for that October low anchored VWAP to be perfectly right there, so not as important. Let's take a look at the volume profile on the weekly. There it is. And just as a general reminder, I mean, this is a major spike overhead. We're trading at all-time highs, basically, so there's not a lot of volume commitment up here we're concerned with. There might be something to be said about this level right here. Just noting that there's a small volume peak before coming out, and then again, a little bit lower. And that number, it also makes sense structurally, right? As a flat top, that number is going to be closer to 400 flat. Nice psychological area as well on our chart. NASDAQ daily time frame chart expected move here. Upper bound is at 415.36. Lower bound is at 403.66. The trend is certainly up. We just produced a higher high with the gap up from the Thursday session. And you could start to think about Friday's low as a potential daily higher low from something like here to here. Because yes, we have flipped into an hourly downtrend over the course of the 2-day trading span Thursday and Friday. We are coming from the highest high. So the trend has not been jeopardized. It still remains in the upward direction. Now, it looks like a mess over here, but things certainly start to clear up as we take a look at the hourly time frame chart in terms of levels that we care about. We know that the volatility has been somewhat muted over specifically Wednesday and Thursday. Here is your Friday breakdown. Notice on the NASDAQ, our equivalent to 473.75 on the S&P was 408.50. And 408.50 actually was violated by a bit larger of a margin than what we saw over in the S&P 500. You'll also notice that your lower high is not up against the lows of Thursday's session, but rather up against the lows of the Wednesday session, as well as your previous highs before experiencing that breakout into the end of day on Tuesday. So larger issues start to show up here on the NASDAQ when we take a look at this hourly time frame chart. If this is truly going to be a look above and fail, the first step is already there, the lower high underneath the top of the balance range. We're starting to get that into the afternoon of Friday. All the same commentary as to what we just discussed on the S&P. Lower highs that continue underneath 410.25, in my eyes, are even more dangerous on the NASDAQ compared to the lower highs underneath the S&P 476 level, right? Because we're already inside of this balance range. Lower high there, and again, over time, the target should be down here at 404.25. There's relative weakness. Just look at your market minder window. S&P's on Friday down 0.25%, and the Q's closer to 0.5%. So overall, thinking that if this starts to show some larger cracks with the lower high, if there is no recapture of 410.25, I certainly would not be aggressive on the long side over in the S&P 500. So the Q's level, it's just the big one right here, 410.25. You've got to get a higher low back above, or otherwise, I should say, it's just danger. It's danger underneath 408.50 again, and it would certainly seem more likely, noting that this, of course, is a very strong hourly downtrend with the difference we already discussed with this high and this prior low over here. Let's check in with our VWAPs. Let's take a look at the intraday. There it is. And you are getting confidence still around that 408.50. And I can respect how into the afternoon session, the last, closing bell before the end of 2023, there was an attempt for lower, but the buyers somewhat stepped up at the retest of the level and the VWAP. So we'll give them a little bit of leeway here, but it's got to be almost instantly on the Tuesday session early this week. It's got to be a break and higher low. If it's not, this strikes me as too much of bear flag consolidation, something that looks like this, right? And then a breakdown here under that 408.50, as we've been pointing out, just tends to get fairly nasty. We didn't do this on the S&P because the breakdown was not as large, but let's just take this out. From a fib perspective, we're rejecting around the 50% mark. We did end up closing underneath the 38.2. The 38.2 is slightly underneath the structural element at 410.25, so take that with a little bit of a grain of salt there. But for the most part, again, this is just a little bit more dangerous. Instead of beating the dead horse, we're going to continue along and take a look at some of the internals for the NASDAQ, and you'll see the same thing. More bearish developments throughout the course of the day out of the internals, even getting into trend lower zone out of the advanced decline line. You'll notice that on Thursday, the cumulative build was more bearish than what we saw on the NYSE, and Friday, same thing as well, much more bearish than what we saw even on the Tuesday session where there was that decent build with the end of day breakout over here. So it looks as though we might be ready for a pullback. Let's kick off 2024 with a little bit of a pullback. Doesn't seem unreasonable based on what's happening here in the tech sector. Remembering also that, not for nothing, your XLK, which is almost, the Qs are somewhat of a proxy for the tech sector, right? That's 28% of the S&P 500. I know, everybody who makes it through the sectors already knows that, but let's take a look over here at the market profile to round out our NASDAQ side of things, and it's going to be a rinse and repeat of the commentary over on the S&P. Value area is in the lower distribution. C period separates an upper from a lower, and this, of course, is overhead supply. This is a very interesting, almost textbook took normal curve distribution over there on Thursday. But regardless, you'll even notice that the highs certainly rejected value area low. We fell away from it. There is a poor high. There's no excess at that high. So if we do trade into distribution number 1 up here, I would expect a break of that high to yield higher prices and go on a bit of a stop run. But the issue, of course, is that you've got to get there first. As of right now, this is overhead supply. This is overhead supply. Even the point of control from the Tuesday session is above where value area was from Friday. So as of right now, things sort of point to, in my eyes, a pullback on the smaller time frames, but the higher time frames definitively remain in the control of the buyers. And the finale for the broad market is IWM Russell 2000 and the small caps on a monthly time frame chart. Very, very impressive month of December and November, to be honest with you, coming from the bottom of the monthly balance range here from wall to wall and breaking it in the upward direction to close out the year. Very impressive stuff. Firmer recapture of our monthly 50 SMA. If we're talking about measured move here, as we know, any balance range really is looking for a doubling of the balance range. So what we can do is just look for a 100% extension over the top, and that brings us not quite to all-time highs, but certainly 230, let's call it 234 as a measured move target would be the doubling of this balance, stacking it directly on top. Certainly a flat top, and it makes sense resistance-wise. This is a bit of an anomaly for that final push out of small caps before fading off into the oblivion earlier than the other components of the broad market. So monthly chart looks constructive. Walking forward from here, ideally, you just continue to get higher lows over this area at 198.41. Now, what are the odds of that considering where we've closed for December? I mean, you'd have to just see an instant continuation of the rally for January and then a pullback, hold the higher low. I do think it's reasonable that it would, a shallow, very, very shallow pullback here, then equal high break back to the upside could be what we're looking for. The curse has started to break with the high being over the top of the monthly balance, but a little bit of pullback here, something that then moves in the upward direction, would not be unreasonable, again, considering that we've come wall to wall out of this particular chart. Let's take a look at the weekly time frame, and we're actually going to grab more years here just so we can look at the proper anchored view apps in a moment. But on the weekly time frame, you are getting the most definitive inverted hammer, right? This is a red-bodied inverted hammer, just indicating that the sellers were able to push prices back down underneath the opening print here for a very weak close at the bottom of the weekly range. We did not see that in the NASDAQ or the S&P 500. So again, does the theory make sense that you could see a IWM, pullback? Absolutely. Much more of a firm close inside the body of the previous weekly range as well. But keep in mind, remember, this is a very aggressive breakout from wall to wall on the monthly chart, lows all the way up to these highs. On the weekly time frame, where I would be looking for a higher low is somewhere around this 190 mark. It is this previous structure. It's the right shoulder of this as a head and shoulders. It's well above the 200 SMA on the weekly. We could take out our good old Fibonacci's from the low up to the very high of the most recent move, and your 38.2 is actually a little bit deeper than that 190 area. It's at 188.83, and that actually does make sense based on some daily structure. We'll see around 187 in just a moment. What about the anchored view apps? Let's take a look on this good old weekly time frame chart, and I'll auto zoom this so you can understand where the gray dotted ones are coming from, right? Pre-sickness high and sickness low, of course. If we zoom back in, this is your all-time high anchored view app. You're getting a lot of confluence if we were to get a pullback. So remember on the monthly, I said it wouldn't be unreasonable for a shallow higher low and then continuation back over the top. I'm sort of thinking about how this band of anchored view apps, how the 38.2, how all of this can sort of act as support below if we see a retracement, right? Like, let the small caps cool off just a little bit. It's not the end of the world. I wouldn't want to see a deeper retracement than really that 187 area, considering that the view apps will start to provide confluence. You've got that 38.2, all the good stuff we've just referred to. Then lastly, we'll finish it off on the weekly with our volume profile for consistency. Auto zooming, this is far too many weeks. Let's drop this down to years, not weeks. A 5-year chart will do. And again, the illustration here is that there is a high volume node around this area. There's multiple high volume nodes. Obviously, there's one lower inside of the balance range as well. But this peak is kind of what I would be thinking about as, again, your shallow pullback, something that then continues in the upward direction. We know that if we can stay over this area here, that would be the most ideal, right? That is also a high volume node leading to a very low volume void. And then up above, this is definitely more aligned with the doubling of the range that we just saw on the monthly time frame chart. So I would be very constructive on the IWM and small caps as a whole as we move into 2024, as long as weekly pullbacks remain somewhat solid. Let's just use round numbers over 190. The daily chart shouldn't really be that surprising considering the weekly we just saw. There's a pretty large breakdown on that Friday session that violates a pretty key level right here at 202.20. That was kind of our line in the sand to remain above the top of this as somewhat of a daily balance area. Certainly on Wednesday and Thursday, this is a 2-day range. We've broken down from that. We've more than doubled that range, so a breakdown is in force. If this is look above and fail on the daily, of course your lower high is now underneath 202.20, and the downside target would firstly be here at 199. Don't get me wrong, that is a strong level on the daily time frame, but below that we know there's a gap and then very thin structure. Here's your gap, and that is going to be underneath 196.50, fills down to 193.60, and then here's the weekly pullback level we were just referring to, around 187.75, 188, 190 was just the round number we were using. You can see how on the daily chart there's really not a lot of structure there, but this breakout retest area would strike me as substantial if there were a larger pullback in the first place. One step at a time. If this is truly going to be a daily look above and fail, you need that lower high underneath 202.20. Let's take a look at the hourly time frame chart, just kind of understand some more nuance of what's happening here. So definitively, if this is going to be your head and shoulders, I mean, the first step is there with the intraday lower high on that Friday session. Notice how we got that uptick, but instead of finding a rebound into the true close of that Friday session, we actually closed weak, making a new lower low on the day. So it does seem as though bears are taking a bit more reign, if you will, over on the IWM small caps. And as we know, this has acted as somewhat of a leader, at least intraday. When you're getting that push and pull between the NASDAQ and the small caps, generally speaking, your S&Ps will remain pegged in between. So if this is moving aggressively in the downward direction and the NASDAQ is just slightly weak as well relative to the S&P, I would tend to think the S&Ps would play catch up in the downward direction. So head and shoulders, we can see it as clear as day. Even if there is a rally attempt over 202.20, I mean, it's a good first step, don't get me wrong, and maybe this starts to feel a little bit like an hourly double bottom. You're over that neckline, but this is menacing overhead supply at this point in time. Think about it. Anybody who was a long in here thinking, oh, here we go, we're getting a daily breakout of the IWM, which was certainly the case. Like, that's not to poo-poo the buyers up here. That's a reasonable break of the range. Healthy consolidation, you just never got followed through. So stops should have been triggered underneath. But if you're still irresponsibly holding that long and you're looking for a break even, where do those buyers sell? It's on the retest of 203.50. So even on the hourly time frame chart, we can remain in a downtrend if we go highs, lower highs, all the way up against 203.50, then you're still looking for that rotation back in the downward direction. Now, 199 is an important area because if we look back to our left, it's kind of where this rally came from. Perfect test over here, lower highs underneath, and we haven't tested it since this larger break. So in my eyes, 199 could be a strong area for buyers to step back up, and we know the deal with the thin structure underneath us. As of right now, early on in the coming weeks worth of trade, yes, the sellers absolutely have the upper hand out of small caps. Let's finish it up with our good old intraday anchored view apps, and what you'll notice is that this is the only one, right? There is the high of where the liquidation break came from 2 Wednesdays ago. You actually use that as resistance instead of support, like what we saw over on the S&P and the NASDAQ. Once again, another feather in the cap of our sellers in terms of relative weakness. Here are the internals for the Russell, and what you'll notice is much more substantial volume outflows on the individual session from Friday as compared to Tuesday's inflows even. We know that Tuesday was the breakout day, but you actually had more volume outflows on Friday. And again, this strong internals activity in the downward direction here is not indicative of liquidation break. I mean, liquidation break is when everything looks bullish over here, let's say out of the cumulative build, and then all of a sudden buyers just get tired and snap to the downside. That is not the case. We certainly, I just want to make sure everybody's clear on the terminology here. Liquidation break is not every single move you see in the downward direction. We happen to get like 5 or 6 of them in a row, but Friday of last week does not fall into that category. We do have stronger sellers who are participating in this market to the downside. Let's wrap it up with our market profile for the Russell. Let's auto zoom that so we can kind of see what's going on here. And you can just see, look at the nasty weakness out of Friday. Not for nothing, but this is just like, totally bearish consolidation on the lows. Value area is certainly lower. Point of control is certainly lower in here. Any reattempts to sort of close some of these singles will be met with resistance here on the reattempt of overhead supply, right? So nothing about this chart as well kind of stacks up in the bull's favor. Small caps are in the control of the sellers. Jumping back on over to the platform to evaluate the weekly performance of our sectors actually reveals some concerns, and we brought these concerns up on Wednesday's episode. The XLP consumer staples leads the pack up 1.35%, followed by utilities, healthcare, real estate, industrials, and then you see some of the heavier weight risk on sectors below. I mean, tech did close green, as did financials, and at the bottom of the barrel, it's energy, which is classically a lightweight sector, but discretionary didn't really perform, down about, 0.6 of a percentage point there, and communications down 8 basis points. So you didn't really get follow through out of the heavier weight sectors as the market was trying to grind in the upward direction here. That was Wednesday's issue at about roughly midweek. It was a risk off rotation. That continues to be the case as we get this pullback and attempted rebound into the end of the week, right? Friday's hold of 473.75, don't get me wrong, objectively holding that level is good, but if it means that these sectors are supporting us, I don't know how much longer I would trust that level. Let's check in on the structural charts and evaluate what's happening, because I want to be very clear. We don't have leadership issues in the grand scheme of things. It's just this final attempt to push out of the daily balance in the S&P. So consumer staples have yet to even take out this high. They've hardly recaptured the big breakdown from October. I'll continue to reinforce that idea. Uptrend is an uptrend is an uptrend. It helps the S&P. We just don't want it leading as the S&P itself is trying to break out, right? Next up, utilities. Same commentary over here. It's hardly recaptured and rebounded from the October breakdown, and we're certainly off of this high. So we're not getting leadership issues in the grand scheme of things out of these lighter weight risk-off sectors, but in terms of relative performance this week, yeah, not great when your S&P is trying to break out of this as a daily balance range being led by lighter weight and risk-off sectors. Let's move along and take a look at healthcare, a D for defensive sector, but as we know, second heaviest weighted sector by market cap. So maybe this is preventing some larger drawdowns in the S&P, but it's certainly not a risk-on indication. I would say that this strikes me as being more neutral. If you get the equal high breakout up here again, it's going to keep your S&P from seeing an aggressive drawdown, but I wouldn't be bullish on the idea that healthcare is leading a rally. Next up is real estate. This, obviously being rate sensitive, is trying to produce that double top break. Certainly any consolidation up here, anything that really keeps it out of this range. We've talked about these charts day in and day out. There's really not much to say on the bear side until this flips either into a daily downtrend with a lower high, triggering the double top underneath the neckline at 39, or there's a weekly breakdown of 37.80. Sure, this would be downward pressure, but it's such a lightweight sector. I would say that this break and just spending more time up and over 39 is more meaningful. What's going on with industrials? 8% of the S&P, certainly a little bit heavier weight, obviously breaking towards new all-time highs. Hard to be bearish on this chart, just consolidating up here near these highs, but it's not a game changer for the S&P. XLF is definitely much more of a game changer, and what you'll notice here is a look above and fail, right? If this is a balance range, we started to break out on Thursday, and on Friday we're right back down into that range. Now, I wouldn't be bearish on financials until we actually break back down more firmly underneath 37.25. Reason being is that the sellers had their opportunity underneath, and so far, I mean, it's been nothing but just a higher high. So a higher low is on the table over that level, but obviously to get there, maybe early on in the week, you could start to see or continue to see some bearish pressure for the S&P. So watching 37.25, if we get the higher low, strikes me as being healthy and solid. If we get the lower high underneath, time to buckle up for a bit of a deeper weekly pullback, I imagine, in the S&P 500. XLK, similar commentary over here. Obviously, we're sitting at new all-time highs, so it's very difficult to be bearish, but we do have a look above and fail in force from Thursday and Friday. If we support or if we target the bottom end of the range at 190, it's still very difficult to say anything other than like daily bull flag, weekly bull flag. Things start to deteriorate more meaningfully if we're underneath 190, but still at that, you're getting a weekly higher low attempt at the top of this balance from in the past, 186.35. So, the idea is not that the market's going to make an Armageddon move in the downward direction, but the idea is we might start to see some more balance up here at the highs in the S&P as opposed to just straight up momentum continuation as we've been seeing for really November and December as entire months, right? What's going on with energy? Certainly an opportunity for still the inverted head and shoulders, watching that neckline at 85.50. Deeper pullback happening on Thursday and Friday. So it's just a patience play here. You're in the range, not really impacting your broad market as a whole. XLY, discretionary, is just balanced. It did not break or even attempt a higher high over 182. So you could even say, maybe a lower high if it is going to turn into a double top. We have thin structure underneath. We know that we could get a weekly retest of 175, prior resistance, right? So again, pullback seems very reasonable as you start breaking down through some of the sectors, but outright market collapse, outright downtrends, no, not yet. Let's take a look at materials, lighter weight sector, the lightest weight sector, obviously, of them all. Look above and fail in force, so we'll take it at face value. value. If it rotates down here, it's really not going to impact your S&P. I would say making a new swing low, which would be underneath the liquidation break low from here, so 84, underneath that, yeah, maybe a little bit more impactful, but as of right now, just a small indecisive doji on Friday. Last but not least is communications, and this is worth talking about, obviously, because it's heavier weight, definitely more of a risk-on indication. Thursday is a failure to move into the overhead gap, right? Not for nothing, this is a gap. Thursday's upper wick pokes into it. Friday is obviously back down underneath. Now, a lot of these bars have been contained within the Wednesday range of, again, 2 weeks ago, so it leaves me open to the idea of just like, honestly, sideways consolidation, balance. This has been a very impressive run off the lows. Is it reasonable that the weekly chart could get a break, retest higher low over 71.25? Absolutely. So I think the name of the game for the S&P in the early stages of 2024 is dialing back expectations of the straight up rallies that we saw off of the October lows here and the follow through November and December, and maybe saying, it wouldn't be unreasonable for the market to consolidate up here and really digest some of these gains. We're not seeing indications yet that would suggest, oh no, the market's going to crash all the way back down to, like, let's say 410, the October low, but slow down, pull back, definitely seems reasonable at this point. Here's the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. We're looking at yearly charts instead of 3-month charts. This, of course, is bullish for the S&P. This, of course, is bullish for the S&P. Notice that financials are trying to make a move in the upward direction, but there's still a lot of damage that was done from the SVB breakdown that can potentially act as a theme into early 2024. If the market's going to remain risk on and tech is technically going to take a breather up here, relative performance can come from the financial sector retracing some of this large breakdown from the area back there. It doesn't mean it has to happen that way, but it's one possible idea to think about throughout the calendar year. XLY is another one that could start to perform relatively well if we see a break of this resistance trend line. We have a low and a march of an uptrend that has recaptured the upward sloping now 50 SMA. A higher low reattempt to that trend line in short proximity of time that breaks it could spur some relative outperformance from discretionary, which, as we know, is also a risk-on indication. So the two big sector themes I would think about early on in 2024 are financials and consumer discretionary. This, in a downtrend, is bullish for the S&P. This, in a downtrend, is bullish for the S&P. Not seeing larger indications of a risk-off rotation on the higher time frames coming for our S&P 500, unless there's a big bottoming process that takes place. Now, sure, we are at the lows. It's, maybe these will mark the lows. We just don't know yet. There is no reversal process that's happening. These are still firm downtrends is the main point I'm trying to make. If we look at some specialized ratios, XLK, SHY, still looking bullish up here. Similar concept over in the XLK, XLU. A little bit more of a pullback there, but still well above an upward sloping 50 SMA. You can see the pattern. Low, high consolidation, higher low, consolidation, higher low, consolidation. Will we get a higher low and continue this stair step? Seems possible, and of course that would strike me as a bullish indication for the S&P. Next up, last but not least, apples to apples, consumer discretionary versus consumer staples, break out of the balance, higher low capable over an upward sloping 50 SMA. This does strike me as a risk-on indication for the market. Let's move along and take a look at the dollar, what's happening with the good old Dixie into the end of 2023. It made the full retracement. This was a look below and fail on the original monthly balance back over here, but we did find ourselves at 101 into the end of 2023. Would you look at that? So as we know, that alleviates headwinds for the S&P, or more properly said, it continues to act as a tailwind for the S&P, moving in the upward direction. And if we take a look at what's going on with the gold contract, let's see what GC is up to. We know that this is threatening a huge move into all-time highs. Not for nothing, let's go to a max available time frame here and just point out, right, this is your monster cup and handle into blue sky territories that really doesn't sit well with most people, remembering that gold is, it's a hard asset. It's D for defensive. It's not really what you want to see if your market's going to continue to rip in the upward direction. Now, to some degree, right, the dollar and gold play against each other. So when the dollar is moving lower, it's a tailwind for equities, and generally speaking, gold is moving higher in that case. That's fine, but like a huge breakout of this as like a yearly cup and handle, that would not really be a huge bullish indication for equities down below. So we'll monitor that into 2024. One of the comments I've made in the past is that the metals tend to be a heartbreaker trade, and currently silver is saying, not so fast. Gold, dial it back a little bit. If this is your cup and handle, it's nowhere even close to all-time highs, and bringing it back on down to a reasonable time frame chart, we're really just consolidating sideways. We know that this was possibly an inverted head and shoulders. The neckline retest somewhat held, and now we're back lower. This is a breakout into the end of last week. Didn't really hold. We're lower. So silver's like, all right, let's dial it back over there in gold. And I would say that that's kind of keeping us a bit more neutral on the relationship. And generally speaking, we'll continue to watch the dollar. And what the dollar does will tell us more about what equities should be doing down below over here. Speaking of dollar, we should talk about rates. What's going on with interest rates? Just a grind lower. I mean, we saw this big drop off over here and then just a grind lower into 3.83 out of the 10-year, which is substantial from this perspective back here. The breakout, retest, higher, low, and go. So the more we can just consolidate around that, the better I would think that the bearish odds are for continuation in the downward direction. Now, this is sort of where we can start talking about the promise of rate cuts. Remember that the market is pricing in roughly 6 rate cuts, and this is the pricing in of 6 rate cuts. If Jerome Powell does not give us 6 rate cuts in 2024, and this starts to creep in the upward direction, I do believe that could bring some sort of pullback in your S&P equities. Now, I wouldn't argue, all the way back down to the October lows, but a little bit of a retracement higher here wouldn't be unreasonable for the weekly pullback we were discussing to SPY 459, and the SPX that's, roughly around 4,600, give or take. So the idea would be any rally attempts that are more substantial out of the 10-year, if we can find a lower high, the most important level to find it underneath is 4.333. So continue to monitor that level right over here. In terms of the inverted ZT, this is the 2-year, and it most closely tracks or is a suggestion of what the Fed is or should be doing. It's just mildly lower. So we saw this big breakdown, right? That's where we saw the TNX breakdown, and it still remains on these lows. The market hasn't budged about the expectation of 6 cuts. Let's take a look at the tracker tool. So there you have it, all 6 rate cuts being priced in for 2024. Just a little bit of a pause here expected into the end of the year, almost a year out from exactly right now, the end of December, right? So if the promise of 6 is on the table, we know that we've got a multiple expansion in the upward direction. Any changes to what we currently have in front of us start to pose a threat in terms of downside for this market. What could possibly throw a wrench in the mix, you say? I would argue that, higher for longer might be the case if unemployment data continues to just remain rock solid. We know that inflation is subsiding if we go back to the previous week. And if we take a look at PCE, we'll just open up this chart over yonder. We know that PCE continues to move in the downward direction. We know that annualized, it's not quite there at 2% yet, but the quarter over quarter is definitely there. So good first steps out of inflation. And the Fed's dual mandate says that the labor market is really what they care about next. Inflation, the war is being, I would say at this point, deemed as won. The employment claims still come in at reasonable amounts. I mean, as long as we're sub 250, that's the threshold that we generally use. As long as we're not getting more than that, I don't believe that the Fed is going to suddenly pivot just to save the labor market. Now, next week, we start to get the full labor report with JOLTS early on Wednesday, 10 a.m. there. And then as we move forward through the week, Thursday is ADP non-farms, weekly unemployment claims, initial claims, the non-farm payroll change, that would be a big one, and the unemployment rate, the monthly rate. 3.8 is the expectation, 3.7 was your prior. If this does not see an uptick, if we don't go to 3.8 and we stay at 3.7, or I mean, this would be insane, but imagine going to 3.6. If we go to 3.6, your Fed tracker tool is going to start suddenly looking something like this. Pause, maybe then some cuts to get to like here by the end of 2024. And that to me would be interesting because it suggests that people remain employed and therefore spending will likely remain elevated to some degree. But you're not getting the promise of the 6 cuts. So what does that do for the expectations of the market? I would imagine that this could align with, I can envision how this happens, right? The next week or two, we see a pullback in the S&P based on all of the evidence we've just discussed in the candle charts. Now, when we look at this fundamentally, if the labor report remains stronger and more solid than Jerome Powell was maybe expecting, hey, there's no need to cut rates. I mean, everything's going fine and dandy. The economy remains incredibly resilient. Why would we cut rates? We're winning the battle on inflation. Employment doesn't seem to be budging. Let's just remain steady here, right? That's a possible situation I could easily see unfolding as we move forward here into the early stages of 24. Let's take a look at our risk appetite charts. What's going on with the TLT ratio to the S&P continues to go sideways over here after breaking the resistance trend line. One of the themes in 2024 is going to be the return of fixed income. I think that a lot of people were buyers down here, or at least big money. We're talking about firms, or even up here as we wound down the end of the year, firms wanting to lock in higher rates. So So you're seeing this outperformance in my eyes because people wanted to get in while they could and lock in a longer duration. Remember that the shorter duration was the favored outcome for most of 2023. If I could find the right span, there we go. That's this right here. That's this right here. That's this right here. This is the flight to safety. Now that this is moving in the downward direction, it really doesn't, it's not indicative of that whatsoever. People are willing to take more duration risk in the government-backed bonds. I mean, the SHY-IEI, we're talking about really short-term stuff, moving in the downward direction. People are favoring the longer end of the curve, looking for stronger fixed income over, again, I know I sound like a beating drum here, but more duration. People want more duration to lock in those higher rates. And it doesn't strike me as a flight to safety style trade in the TLT ratio to the S&P because credit spreads continue to contract. Now, into Friday, we got this very interesting uptick down here, and it might seem alarming on the short end, which is the SHY-HYG, but we're still underneath a very aggressive now downward sloping 50 SMA. This is a very aggressive breakdown. Is it reasonable that we could get a counter trend move? Absolutely. So I don't think it's, it doesn't make sense to me. I'm not seeing the indications that, oh no, the market's just, there's going to be this huge rug pull and there's going to be a big collapse. The evidence is just not there, even when we're looking at the bond market. Here's the HYG in isolation, getting a little bit of a lower high double top, but we haven't really triggered underneath this level, which is closer to 77.50. If we break down underneath that, just to give a quick comparison, yeah, let's go with this. What's that number? 77.25 in the HYG, 77.25. If we break down underneath that, that would suggest an equivalent breakdown of your lows here in the S&P 500. So that's where your divergence really starts to step in, and we're getting close as of Friday's close. So again, does this align with the pullback theory so far? Absolutely. Would it suggest like, here's one for you. Is this doing this while this is doing this? Absolutely not. So it's not massively divergent, but a little bit of a pullback would certainly be warranted at this point based on what we can see in front of us. Here's Bitcoin on a daily time frame chart, high and tight consolidation. I mean, just treat it for what it is. It's a little bit of a wedge up here. If we can break out, great, increases risk appetite. If we break down, it's not the end of the world on like a weekly time frame chart. We know that we could get the retest of this breakout level back down below. Something that looks like that is still constructive in the upward direction. A lot of talks about that ETF. We'll see how that plays out into the early stages of 24. What about market breadth? A little bit of a contraction here, even as we tried to print a higher close, right, on the week over week count. So this pullback, again, it aligns more so with the pullback theory we're thinking about in the S&Ps. I think that, wouldn't that be something? The first week of 2024 and we see a pullback, everybody gets flustered, thinks it's the end of the world. I wouldn't say it's the end of the world. Breadth still looks constructive, but a pullback seems reasonable. Same thing over here in the SPX A200R. It's still moving in the upward direction, but very, very slightly. This is aligned with, it's not really divergent from what we saw in the S&P itself. Let's finish it up in terms of A charts with the SPX A50R. 50 SMA, still doing fine. Still in this I wouldn't call it overbought, but strong and potentially contrarian area. If we start poking up and over 90 as this is pulling back, I would just think that if this pulls back and this stabilizes, man, you're talking about breadth really increasing across the market. And speaking of that, we could take a look at the RSP equal weight. Notice that this has, it's pulled back a little bit on that Friday session, but it's still well above that 155.50. So this is very constructive for the breadth of the market. If that can happen, if higher lows are over 155.50, no reason to be a panic seller in the S&P weighted down below. Same thing, obviously, over here in the NASDAQ equal weight, your level would just be a little bit lower actually at 80.90. Staying over 80.90, good to go. I mean, that's a deeper pullback than what we saw with the panic sell from the Wednesday of 2 weeks ago, right? So you've got some room to go over here. And again, the suggestion would be that this pullback aligned with this pullback, no reason to be a panic seller in the indexes. Let's take a look at the transports versus industrials consolidation. This is still saying not yet. This is still saying not yet. This is a little bit divergent. As a double top here breaking down underneath 15.7, I'd put my thinking cap on. And again, I think that this more so aligns with a possibility of a pullback into the early stages of 24. Let's finish it up now with volatility. Volatility really remains suppressed, moving lower on that Friday session after an intraday spike higher, but not really. We know about volatility. We know that not many folks are really believers in it anymore. So let's take a look at the VVIX. I would say that this is much more of an accurate representation of what we should be thinking about. And it's still floored near the bottom of the overall range. It's not in complacency zone. I would say that this is healthy. I mean, the market currently appears to have a healthy volatility sort of outlook, if you will. We're still in deep contangos. Even if this moves higher, we're not going to get into backwardation anytime soon. Same thing over here in 9 versus 30-day VIX and the 1-day VIX as well underneath our sort of scary period from the October area, we're just continuing to produce lower highs underneath. So volatility remains healthy. Again, not seeing any indications currently of an Armageddon style sell. A pullback seems reasonable at this point, but really nothing more than that. If you've made it to this point in the video, I appreciate you coming out to the show. I hope you have a fantastic New Year holiday, and we will see you on Tuesday for the pre-market prep. Let's kick off the core list of companies with Apple on a daily time frame chart. We're talking about Apple as a head and shoulders, right? This, or even maybe, dare I say, a Man Ray pattern, if we give it one of those, breaking down underneath this 192, which seems reasonable after the lower high rejection of 195, really opens the door for the full rotation to the bottom end of this range at 188. Now, of course, on a weekly time frame chart, this really starts to feel more so like distribution. If we can break 188 with a lower high, look left, thin structure to retrace. That could be your fall from grace out of Apple in the early stages of 24. Now, of course, a lot of things have to happen for that to be in force, mainly the lower high underneath 188 and the breakdown of your daily 50 SMA. If it can continue to consolidate up here, it's really just in the midpoint of this as a daily range, if you will. I wouldn't be too constructive on, daily patterns happening over there. What's going on? We got two daily charts. Let's take a look at the hourly. There we go. And in terms of the hourly, double top, there's your neckline again. There's your rejection of 195, setting up an H pattern here, equal low breakdown 192, start trading in the downward direction. 190 is a thin structure retracement, and then underneath that 188, even 188 is actually a thin structure retracement, V-shaped bottom in the most recent interaction off of that level. For the buyers to really have something going on here, you've still got to produce like a double bottom, some sort of reversal pattern, and a higher low over the neckline of that reversal pattern. So 195 still strikes me as important. Let's take a look at Microsoft. Microsoft is just fine on an hourly time frame chart because you can clearly see that we've got ourselves a beautiful ascending triangle marching in the upward direction with consecutive higher lows, beautiful consolidation in this upper portion outside of the original range. Remember that we had multiple look above and fail, look below and fail, look above and fail, but this time we caught ourselves for that higher low. So the more time we spend outside of this balance over the top, the more bullish this consolidation seems to me, and we'll look for breaks and higher lows over 376.25. We started to go on Friday. That was like the early morning trade and really sort of pittered out as we got that big breakdown intraday. But notice how Microsoft is basically right back at the breakdown area. It's a little shy. You still want to see that higher low confirmation over 376.25, but the pattern is very straightforward. If this is going to turn into a failed move, if this was the beginning stages of a failed breakout, I would tend to think that your stronger short indication is just waiting for the lower high underneath and back down inside of the original balance highs at 370, 350. So one step at a time out of Microsoft. Next up, Google. This chart is really not attractive to me. It hasn't been that way for a while, or it hasn't been attractive, I should say, for a while. The first place where it lost its shine was after this failed as a breakout, right? This consolidation just at the top of this as a range, and then this big breakdown lost its shine in the upward direction. We did have a daily uptrend over here. Now this is just much more so balanced. So I would just take this in stride and wait for something more constructive. Ideally, buyers see something that looks like this into the future with higher lows getting back up and through this thin structure at 140.70. Sellers, if you just keep it sideways in here, maybe it turns into a longer distribution. But even at that, possibility for a gap fill reversal and support off the bottom end of the range, just not thrilled with it. It just seems like a daily balance range to me and not much going on here until we can actually exit this either here or here. And we'll look for something more constructive. So Google, not really taking a top spot into the early stages of 24. What about Amazon? Very similar in terms of balance that's, it's just painful throughout the majority of the week. And then we finally got this snap into the Friday session. So thin structure continues to retrace down to 150. The beauty of Amazon is looking at it on a daily time frame chart. You've got yourself a beautiful bull flag. This was our first break. We have 2-day highs there at that 150. If we can continue in the downward direction, I would be thinking about pullback buys here, or even if we go through it, I would still be thinking about pullback buys here at 147.60 for just daily, or even at that point, maybe it's a weekly higher low, considering that you've already been in an hourly downtrend here. Technically, that would be your last daily higher low, right? So weekly higher low possible on a retest of 147.60. Still thinking constructively about Amazon for the reasons we've just discussed. If the sellers are really going to have something going on, you just want price acceptance back within this range. This turns into a massive failed breakout, then over time we'll start to break down. But for now, still thinking along the lines of pullback buys. If buyers really want something impressive out of the gates, it's your higher low here over 133.80. You can just see that as a flat top breakout point. NVIDIA, up next, what's going on with NVDA? We know that let's actually take a closer zoom. There we go. This was a great example of a chart, and hopefully you've really studied how this is unfolded. This was a beautiful daily uptrend. It was a daily channel, right? You could do something like this, you could do something like this, and we were just marching in the upward direction. Then this was an hourly downward channel, right? Boom and boom. Breaking that via hourly double bottom, consolidation above, beautiful break. Now, granted, Friday was very, very sloppy out of NVIDIA, but this initial break through the neckline here, nice stuff. Beautiful retest on that afternoon, or I should say early morning session rather, at the 491.20. So very constructive looking chart. I like the way it's respecting the technical levels. Obviously, again, Friday was a little bit sloppy, but for the most part, the close back over 494.50 leaves me to believe that this type of consolidation here is nothing more than just a daily higher low continuing the sequence. If we go to the daily chart and take a closer look, I mean, it's kind of nasty, right? The lower wick of that, but it's still technically a hammer candle. The buyers responded and they're able to close still up near these highs. If we can take that out, I mean, blue sky territories are up above. Remembering the promise of AI, if NVIDIA is going to continue to outperform on that front, which again, law of large numbers makes it pretty difficult for NVIDIA to continue to post earnings growth, or I should say revenue growth, profit factor growth, margin growth. I think they had something, multiple metrics in the thousands of percent in terms of growth. It's going to be very difficult to mirror something like that, but certainly breaks into blue sky territories. I mean, how could you argue that this higher low, sort of like a V-shaped cup and handle, I don't know anybody's cup that can balance on a point like that, but you get the idea, breaks into blue sky territories. It looks constructive chart-wise. The trend is certainly up, and the buyers do remain in control. So we'll leave it at that on NVIDIA. Next up, Metaverse. What's going on with Zuckerberg, Zucchiniberg, the fantasy land, his ACL, all of the sort of jokes we've said about Meta. What do we see here? Wedge breakdown, right? So what's the idea? Stronger continuation lower after any lower highs. Equal low follow through, and we know that the stronger daily retest is actually down here, my apologies, at 337.25. You do have this as a previous pivot, but this is thin structure. Kind of blasted through it. Wouldn't be surprised to see if we do get that follow through in the first place. So again, lower high, equal low breakdown. This is really your stronger daily higher low at 337.25. Here it is on the daily time frame chart, so you can see that, right? There it is, and you could still look for something here, but again, because of that thin structure breakout, wouldn't have the most faith in 342. Let's finish it up with Tesla and then Netflix. What's going on with Tesla's daily? This is important first because we're still technically in a daily uptrend. It's not comfortable, but it is still technically up. We have lows, higher lows, higher lows, higher lows, equal lows, and we're coming from the highest high, right? If we were not coming from the highest high, I would say we would have a neutral trend, but coming from the highest high, still technically in a daily uptrend. If we can support over the top of this balance, maybe it's just like a weekly retest. I mean, it's not a pretty looking chart. Very nasty breakdown Thursday and Friday, but holding on to 246.25, have to give the buyers the benefit of the doubt. Still, let's take it on down to the hourly chart here and see what we have on tap. So you're already starting to get an intraday lower high underneath 253.25, which is really where this started from, right? So as long as that stays below, this is bearish consolidation, and I would tend to think that hourly lower highs really set up an hourly bear flag, and then looking for some sort of breakdown over here. We don't usually use the fibs on the individual companies because, man, we would be looking at a lot of stuff, but there you go, not for nothing. Your 38.2 keeps. Technically healthy bull flag consolidation underneath that figure at 253.25. So we're pretty straightforward on this one. Lower highs continue the bears being in control on the smaller time frame, hourly at least, right? If you do start to find some sort of reversal, if this turns into a double bottom, you could take longs over that neckline to get here, but just understand that rejections off of that get pretty harsh. The stronger and more confident long is just the recapture of that level, 253.25. I think we've beaten that one into the ground. Let's finish it up with Netflix. What's going on with Netflix here? Breaking down from this, remember that we were saying nothing really good was going to come from that, and you are getting that thin structure retracement over here, but only to the top of, let's go to the daily chart, only to the top of the previous breakout point, right? And you can see flat top, and as of right now, supporting off of that. So I would not be bearish out of Netflix here. I mean, this is, fine as like an intraday scalp to the downside. That's cool. But you can see that we've actually closed back up and over this prior low. This could possibly hold as a daily higher low, weekly higher low, retesting the flat top and breakout point from over here. And we know that overhead, there's still a little bit of gap to close. So I would be thinking of this more so as a balance range. If we can find acceptance over 486, I would be thinking about, okay, next stop here. And then the better long trade, as we've been talking about for a while, is over 494, right? Because this is thin structure breakdown. This sort of squeezes out some of the shorts, and we're looking for that gap to be in play overhead. 501, 506.60 would represent the close. Last but not least, we've got two additional trade ideas to share with you. First up is MMM for triple M, 3M if you will. And what you see here is an inside bar on the daily time frame chart. If we move lower, looking for retest higher lows over 107.50 and then higher lows to pick us up through the equal high and retarget this breakdown area at 112.20. If you just get the straight up breakout intraday on the hourly chart, you're looking for higher lows over 110.10. Next up for a trade idea is CVS, and that is going to be a wrap for 2023. Can you imagine that? We've got a beautiful daily bull flag and just sort of a daily balance area up here. It's very, very tight and compressed, so be open to a number of disappointments up here. I could easily see a wick through the top and then breaking down through the bottom, or the exact opposite, wicking the bottom, then breaking out through the top. I would probably aim to trade this in the direction of the broad market as a whole. But if the move is up over 79.20, there's really some thin structure overhead into 81.45. The key support, or at least the bottom of the range, I don't know if I would call it key support because it's weakened, based on the number of times we've touched it there, is technically at 78.55. If we break down through it, you could be looking for this as a possible target at 75.41. That's really going to do it, or 75.40. Let's go round numbers only up here in the penthouse. Come on, you guys know the rules at this point. That's going to do it for today's episode of the Weekly Watchlist. Hopefully you learned some stuff about the longer time frame charts. We'll be back to business on Tuesday for our pre-market prep. If you made it all the way to the end of the video, let me know by dropping some cheers emojis down below in the comments section. If you're sophisticated, you could use the champagne glasses. If you're just a common folk like myself, the beer glasses clinking will do just fine. With that said, folks, I truly wish you have a fantastic New Year's and New Year's Eve, however you decide to celebrate, and we'll see you back here on the channel Tuesday for our pre-market prep. With that said, have a green trading week.